All right, let's also welcome in Sonal Varma, Managing Director and Chief India Economist at Nomura. She joins us from our studios in Singapore. Sonal, good to have you on the show. The majority seems to believe that there is going to be a hike tomorrow. What have you factored in?
We are in line with that consensus expectation. I think the core inflation momentum has been uncomfortably high, and purely based on that, we do think that there's a case to front load the rate hikes, and therefore we do expect a rate hike from the RBI, but the policy stance we think will remain neutral. So MPC basically retaining the flexibility to do what data requires. So basically they remain data dependent.
Sonal, afternoon, Ira joining in as well. Just curious to see how you see the inflation picture. I think those who are saying that you may not need another rate hike are saying that, inflation will peak, core inflation will also peak. And by the time this round of policy starts to impact the system, maybe, inflation won't look as worrying as it is looking right now. Do you buy that at all?
I think that expectation, we do agree with that assessment purely because, last July is when we had both the adverse impact of GST as well as the impact of the house rent allowance, and both those factors actually caused core inflation to pick up. So the expectation that core inflation has peaked in June and that the year-over-year rate will decline going forward, I think to a large extent actually stems purely from base effects. But I think what matters more is clearly the momentum. And if you strip out some of these effects like, petrol, diesel, and even the house rent effects, on a month-on-month basis, core inflation has actually been increasing at something like 0.5%, which if you annualize, clearly is significantly greater than 5%. And one of the only reasons why headline inflation is still okay, despite core momentum being very high, is basically the, sort of subdued food inflation readings we have, which I would say to an extent is because of low global food prices, as well as the, supply increase we saw from last year. So therefore, the argument that, core inflation will decline going forward, I think is not enough. What we need to see is momentum in core inflation coming down. And given the fairly significant core inflation momentum we've continued to see, including in the month of June, I think the case is clearly for the Reserve Bank to front load its hike, as I mentioned earlier.
Two factors, Sonal. One is oil prices. The other one is on the hike in MSP. How much are these two contributing to the case of a rate hike at this juncture, do you reckon? And secondly, what happens after, if there is a rate hike tomorrow, what happens to the rate cycle thereafter?
The oil price, since the June policy, of course, oil prices have been largely stable relative to where they were going into June. So incrementally, there's no additional information there. Of course, we do have clarity on MSP, where there is a bit of uncertainty is how much MSP is going to actually contribute to inflation. And there, essentially, it boils down to whether MSP is actually effective, because barring rice and wheat, government obviously does not procure much, bulk of the other commodities and the other food grains. So if they do not procure other commodities, then the MSP increases that have been announced will not have a big impact. Our assessment is maybe 20 to 30 basis point. But if they do indeed put in place the procurement process, there are 2-3 options being discussed right now. And MSPs do become effective, then potentially the inflationary consequence will be much higher, maybe close to 90 basis point. Although I think the risk is that this impact shows up more over the next 12 months rather than in the immediate 6 months. So I think the case for rate action, therefore, does not stem purely because of oil and MSP. Like I was mentioning earlier, core inflation has been quite strong. And if you look at what is driving this higher core inflation, it's actually largely the non-tradable services like recreation, etc., which are driving this increase, which essentially is a signal that domestic demand is quite significant. So even if one keeps aside factors like oil and MSP, purely domestic growth, inflation itself do argue for monetary policy action. To your second question, Harsha, I think at this stage, if the RBI does deliver a hike tomorrow. It's going to be a 50 basis point cumulative increase. Our assessment is that post that, the MPC might decide to see how things pan out. One of the things that we are a bit concerned about going forward is to what extent growth cycle will sustain, because at least at a global front, we are starting to see some signs of global growth cyclically starting to taper down. So if that plays out, then there is also a risk that the domestic growth cycle in India may also peak in the next couple of months, I would say. And if that happens, then some of the increase we are seeing in inflation may start to taper off. So if that's the case, then there is a chance that RBI could go back into a prolonged pause after the August hike.
Sonal, to the point you were mentioning about services and the inflation in the services category, should the MPC or should monetary policy see services-led inflation differently from product-led inflation?
To an extent, yes and no, Ira. I mean, I think, the product-led inflation, you could argue, is being driven primarily by higher commodity prices, and therefore there is more input cost pressure. Of course, just because there's input cost pressure doesn't mean that even product inflation has to go up. If product inflation is going up, that means that there's enough demand for producers to be able to pass it through. But in the case of services, obviously some of the commodity price increase directly doesn't matter as much. And therefore, if you're seeing more a services-driven inflation, like I said, it's actually non-tradable services-driven inflation, then it is clearly an indicator also of domestic demand being strong enough. The other thing I would sort of bring out here is that, in the second half of 2017, when we did see GST increase, there of course would have been a case for some increase in both product and services inflation because your tax rates did go up. But I think what is a bit concerning is that even in the last 6 months, so 6 to 12 months after GST inflation, we've continued to see some of these services inflation staying extremely high, which is, like I said, an indication of domestic demand being quite strong and strong enough for companies to basically pass it through to consumers.
Okay, got that, Sonal. So I'll add one more question on the individual data points. I think tomorrow we'll get the Obicus survey for the end of Q4, and I think going by the commentary that came out in the last MPC, everyone seems to be saying that there was an increase in the capacity utilization. What is your own sense of how rapidly the excess slack is starting to get used up and the implications for the investment cycle thereof?
I think based on the kind of inflationary pressures we have seen, one would suspect that even on a seasonally adjusted basis, there has been an increase in capacity utilization. So, I would reckon maybe it moves, slightly above 75% on an aggregate for the manufacturing sector. But, the question is whether this is a cyclical uptick or more a structural change. Because if it's a structural change, that's when it basically leads to businesses starting to, do more sustained investments, and we actually see a turnaround in the investment cycle. At this stage, our assessment is that this is more of a cyclical uptick that we are seeing in capacity utilization, etc. And like I was mentioning earlier, incrementally, we are also concerned that because of various factors, the China slowdown, the trade protectionism, the electronic cycle slowing down, and many other factors, we do feel that global growth cycle is also at a cyclical peak and is going to moderate. And for India as a net commodity importer, of course, the terms of trade have also turned adverse. So, and the third factor I would mention is that while the Reserve Bank has raised interest rates just one, the fact of the matter is that market interest rates have gone up much more. So we do feel that domestically in India, financial conditions have also tightened. So at this stage, we don't see enough evidence to say that the investment cycle is going to sustainably turn around. And therefore, potentially the increase in capex cycle may still be something we see post the 2019 elections, when we also have some political clarity. Until then, it's more of a cyclical upcycle, and there is a risk that we may be sitting at a peak of the cyclical growth cycle, and second half of FY19 we might actually see some slowdown even in India.
Sure. So, Sonal, I just have one small question. I'm actually a little surprised that you didn't mention the rupee at all. Are you concerned about where the rupee is headed? Because all the policy tools that the RBI is perhaps using and will use might just be blunted by volatile rupee movements. How concerned are you about that?
I would say, we were a lot more concerned about the rupee, maybe about 6 months back when there were clearly bigger concerns on valuation, etc. Since then, of course, the currency has depreciated, so some amount of adjustment has happened. I think to an extent, the stabilization in oil prices is a bit of a positive. But, at the end of the day, I think as an inflation targeting central bank and for a country like India where we get sort of more equity flows than debt flows, there's sort of limited effect directly of monetary policy on currency. What the monetary policy can do is ensure that the indirect effect of currency depreciation on inflation doesn't feed through. And I think it's also very important for the Monetary Policy Committee to send a clear signal that, the credibility to the 4% target remains intact. I think that will have a bigger impact on stabilizing the currency than trying to, defend the currency through monetary policy. So, not as concerned about the currency as we were 6 months back, but I think it sort of boils down to more what the view is on global risk sentiment.